Hi, my name is Sean. I'm founder and CEO of Business 101 Publishing. Thanks for joining our first interview. Today's interview is brought to you by Business 101 Publishing. I'm with Joseph Wang, the author of Central Banking 101, and Inyuk Kim, the reporter for Korea Economic Daily Global Division. I read the original version and reached out to Joseph a few months ago, see if he's interested in publishing a Korean version. And we excited to have Central Banking 101 Korean edition published this month. And this book takes a deep dive into how central bank and the Federal Reserve work. And I'm sure it'll be helpful read for Korean investors, especially considering everyone has been keeping eyes on the Fed and the interest rate for the last couple of years. Can you introduce yourself for Korean readers and what made you decide to write Central Banking 101?
Well, first of all, thank you very much for inviting me. I'm very excited to have a Korean version of Central Banking 101. I have a Portuguese version and two Chinese versions as well, and they do very well. So I'm sure this would be of interest to the Korean audience. So first, I'll talk a little bit about why I wrote Central Banking 101. So I have always been very interested in financial markets. I see the markets go up and down every day, and I want to know what drives that. So I began my career in 2008. So that was a time when the financial markets were very turbulent. Every day, it seemed like the world was going to implode, and the next day you could see the stock market soar. I was very curious as to what drove that, and it also seemed like there was a lot of money to be made in understanding this. But what I realized when I was researching, just what was happening, it seemed like a lot of what was driving what happened in the stock market was what the Federal Reserve was doing. And when you actually read what people were talking about back then in 2008, you would come away with very different perspectives as to what the Fed was actually doing. Some people, for example, at that time, that was the beginning of quantitative easing, would say, you would print all this money, you're going to have hyperinflation, it would be very bad. And other people were say that, that's not how this works. So I realized that it was very difficult to actually understand how the financial system worked and how the Federal Reserve operated because there were so many different types of information. Now, ultimately, I ended up working at the open markets desk, which is the Fed's trading desk in New York City. And from there, I had the opportunity to basically sit at the center of the financial system, the Fed's trading desk, and be able to really understand just how the Fed operates and how the markets work behind the scenes. Because when you are at the Federal Reserve's trading desk, you have access to a lot of confidential data and you were able to talk to market participants throughout the world. So we would talk regularly with foreign central banks, with other large investment funds, with commercial banks, with everyone. And when you spend time on the open markets desk, you are able to get a glimpse behind the curtain that other people don't. And I really developed a much broader perspective on just how the Fed operates and how the markets work. And I wanted to share that with the audience because this is really the book that I wish that I was able to read back in 2008 when I was beginning my journey in studying the markets.
Thank you. Can you explain what Federal Reserve is? What are the roles of the Fed for the overall economy?
Yeah, the Federal Reserve is the central bank of the United States of America. What I've noticed just looking at markets is that what drives markets the most is the actions of central banks. And among central banks, the Federal Reserve is the most influential. For example, recently we've seen markets rally a lot, and a lot of that has to do with the perceived rate cutting cycle that the Federal Reserve may be embarking on. So being able to understand the Fed is really important in trying to have a view as to whether the stock market will go up or down. Now, the central bank of the US, of course, its responsibility is not the stock market. It has two mandates. The first one is price stability, and the second one is full employment. What that means is that the Fed will try to make sure that inflation rises at about 2% a year. Not more, not less. That's what they think of as price stability. The second thing is full employment. It wants to make sure that everyone who wants a job can get a job. Now, this is a target that would change over time because sometimes, for example, as the population ages, maybe fewer people want to work. So it's always a difficult thing to figure out just what is full employment for the US. Now, these two mandates sometimes are in conflict. For example, if inflation is very high, the Federal Reserve will try to raise interest rates to slow the economy down. That would make inflation move lower, but it would also increase unemployment rate. So for the Fed, there's always some tension between these two mandates. And it's a judgment question. Right now, for example, we have inflation that is a little bit too high, but we have unemployment that is really low. So the Fed feels comfortable in keeping interest rates elevated, trying to balance its two mandates. Now, the way that the Fed tries to carry out its tries to meet its mandates is through its tools. Its primary tool is controlling overnight interest rates and its balance sheet. So when you're hearing the Fed raising or cutting rates, what they're doing is they're adjusting the overnight interest rate. Now, the Fed thinks that when you adjust the overnight interest rate higher, that slows the economy down. For example, maybe you are a business and you are trying to borrow money to make an investment, but because interest rate expenses are higher, maybe you will do less investing. Or if you are a consumer and maybe you wanted to buy a TV, but you saw interest rates were much higher, maybe you would delay your purchase a bit. So the Fed thinks that toggling the overnight interest rate affects economic activity. Now, the other tool it has is its balance sheet. The balance sheet is basically when the Fed creates money and goes out and buys longer dated treasury securities or other assets. The Fed does this also in an attempt to influence interest rates. In this case, when they go and buy, for example, longer dated interest rates like the 10-year treasury, they're hoping to put downward pressure on interest rates. So the Fed is always thinking about impacting economic activity through the lens of interest rates, and it deploys either the overnight rate or its balance sheet to try to adjust that.
Can you also explain about the repo market? Why is the repo market important for investors?
Yeah, the repo market is the largest and most important market that you have never heard about. So let me actually give you some idea as to the size of the repo market. The repo market is basically when you borrow money and you put treasury securities down as collateral. For example, let's say I have $1,000 in treasury securities, but what I really want is cash. So then I can take my $1,000 in treasury securities and then go and put it down as collateral and borrow cash against it. So in a sense, it makes the treasury market very liquid. So let me give you a sense of the absolute size of the repo market. So the cash treasury market, so everyone thinks about the US treasury market as the deepest and most liquid in the world. On average, every day, the cash treasury market volumes are about $700 billion a day. The overnight treasury repo market is about 1.5 trillion a day, 1.4 to 1.5 trillion dollars a day. So it's much larger than the underlying cash treasury market. Now, this repo market is very important because it makes treasury securities money-like. It makes it very cash-like. So you can think of it as, for example, if I have, let's say, $1 billion or $10 billion of treasury securities, and I can always take that and I can either sell it in the cash market or either borrow against it in the repo market. This makes it easy for me to raise liquidity, and it also makes treasury securities a lot more attractive as an investment. In a sense, it enables the US government to spend tremendous amounts of money through deficit spending and have a lot of people willing to hold treasury securities because they're so liquid. It can also be used as a market for leverage. For example, if I wanted to speculate on a direction of Treasury securities, I could also buy a Treasury security and fund it in repo. And so in that sense, it's like taking on a margin loan and trying to bet on Treasury security price appreciation. So overall, I think of the repo market as both a market for leverage in case you wanted to have a levered up exposure to Treasury securities, or if you already own the Treasury securities as a way for liquidity. So you can basically easily convert Treasury securities to cash, increasing your willingness to hold it.